Welcome to Charting the Markets on this midweek trading session, Wednesday, 28th of June, as we approach the end of the week, which is a seminal moment in the year because it's the end of the first half, it's the end of the second quarter, it's the end of the month, and of course also the end of the week. So there's a lot going on as we look into this preparation for the end of period. But there's also some other interesting stories bubbling under the surface as well. We'll be covering the market reaction to expectations of potential slowdown because central banks continue to raise interest rates. Let's now introduce our guest for the next 15 minutes. It's Serge Berger from thesteadytrader.com. Joining us on the line from Zurich. Serge, it's good to talk to you again. Let's pick up on this point about how we as traders should look at the end of this period. As I said, it's the end of the first half of the year, so it's an end of a long chapter, and we've been talking about this over the last 6 months, and we've been talking about these moves in the markets, expecting a little bit of a pullback, and it's not really developed. How do you feel going into the end of the first half?
Hey, Jeremy. Yeah, I mean, look, we've had a very strange and, in my humble view, first half. I would have thought that we would see more downside in equities. Instead, what happened is I think investors got very impatient with sort of the constant delay of a recession, even though we do have recessions, for example, technically in Germany. But if you look at stateside, which is kind of where a lot of people focus on sort of the big numbers, it continues to be pushed out. Now, there are dynamics at play here in the very near term. As you mentioned, into the quarter, end of the week, end of the month, end of the first half, that are supportive for risk assets. And we're talking very near term here, though, right? So we can flip to the sort of the bigger picture afterwards. But I brought along a couple of charts here. An easy one here is just focusing on equities, and we're going to look at the S&P 500 as an example. And, you know, without getting too cute, we are seeing more. We are seeing more involvement on the options side again with the advent of zero DTE, 0 days to expiration options. There's a lot of little dynamics at play here that are basically supportive for equities in the very near term, but it also leaves big trapdoors underneath. But really, you know, I would not be surprised if we see the S&P move towards 4,500, 4,550, which is roughly about a 30% move off the October lows. That would not at all be out of question into quarter end, maybe into the very early parts of July. Again, that's a very different near-term move than saying in the long term, from the long-term perspective, we're going to break out to new all-time highs. I don't think we need to break out to new all-time highs. So that's the very near-term into the quarter end here, the way I see it right now.
What is it that's moving the markets? We've seen on the way out, we saw a lot of support for techs. On the way down, techs didn't really have that much downside. But techs are very responsive normally to monetary policy movements. Where are we seeing the big moves in the equity markets?
Well, last year we had big moves lower in mega cap tech, right? So, you know, everyone's talking about Nvidia. It's become a household name, which is a whole nother concern. But you know, that stock last year dropped 65% peak to 12. People forget. What's happening is we're seeing a broadening out, and I think a lot of it is self-fulfilling prophecy. So if I look at this as a portfolio and fund manager myself, and even though I don't have to, I try not to play the chart chasing and the performance chasing game in the quarter end. I see why plenty of funds have to do that. So it becomes a self-fulfilling prophecy. But of course, ultimately, the global economic picture, you know, the way that they will win out. But it's really that it's you know, sort of buying begets more buying, just like selling begets more selling. And I brought another chart here. This is looking at the transports, the IYT, just to give people an idea that, you know, and I'm not expecting any all-time highs here either, but these are stocks that look like they want to move a little bit higher again into the end of the quarter. So it's not so much the fundamentals. I think we're going to have a lot of companies report reality as we get into the second quarter earnings season over the coming weeks. And I think we'll see a lot of this rethinking happening, but it's, you know, and then of course, Wall Street analysts have to come out and kind of, you know, they don't want to be wrong either for, you know, an extended period of time. So it just feeds on itself is really what it is.
Yeah, let's pick up on this point about volatility bumping along the bottom. This is not particularly good for a trader's point of view. We like a rise in volatility. Is this typical going into the end of a big period like this, low volatility?
Yeah, well, so what you tend to see, absent sort of major news, you do tend to see squeezes of in risk assets, meaning higher, towards the end of months or quarters, and certainly into options expiration periods. Is it normal? Normal is always relative, depends on how far you look back. But I will say, to me, one of the highest probability trades right now is just buying some puts on the S&P 500. I mean, VIX last Thursday closed below 13. So if you look at that, on a risk adjusted basis, and you say buy puts expiring out in September, October, those puts are going to make a lot of money. If volatility goes back up, let's say VIX to 20, and of course the S&P a little bit lower. So this is not about calling the end of the world. It's just about mean reversion as economic data continues to get worse.
Let's pick up on some of the other themes in the markets at the moment. We've got the meetings in Sintra in Portugal with the big central bankers meeting. And as we do this broadcast, we're waiting for Jerome Powell to get up and speak. Of course, Powell last week came through with the recent decision on the US Federal Reserve's recent moves. And they decided to skip last time, but they're highlighting the fact they've got 2 more interest rate rises to come at least this year. European Central Bank, we know, is going to be raising interest rates. We've got the Bank of England, of course, very much in the saddle when it comes to raising rates. And there's inflation which seems to be very, very sticky. And as a result of all this, we've got concerns about the potential for the downside in growth. And this is hitting oil. And oil has been an interesting trade. And that is looking as though it really wants to break down to at least 3-month lows and potentially, possibly even further on down from there. How negative are you, or how short should we be on oil?
Well, I mean, with oil, I always have to just say, listen, there are lots of forces here that are leading to gap risk in oil. So usually, what happens is we wake up one morning and oil gaps up or down on news, either supply shocks or some sort of demand shock. So I would just keep that in mind. Having said that, if you look at it just from a simple price perspective, what I think is part of the objective here. We've now seen oil, and this is looking at Brent, sort of way on the 72 area for, let's say, 4 times in a row since March of this year. There are not many quadruple bottoms that I have ever seen that end up, being the bottom. So basically, if I were to just be, doodling on this chart a little bit, I would argue we are likely going to start to see Brent break lower into the mid 60s is kind of my best guess here right now. Again, this is absent any shocks, any whatever, comes out of OPEC or whatever else there might be. But I have a hard time imagining that we're not going to see some sort of a break lower, even if it's only, quote unquote, only 10%, which is actually a big move, right? So 65 would kind of be my thinking here. We could go to 60. But that's kind of what I see. I don't see that economic data get any better. Now, long term, though, and just as a quick FYI, I would argue we want to be very bullish oil, going back to 100 or so or plus, because we do have, the situation with Russia it's only going to make things worse over time. And we are a growing global economy with more people, and we're going to need more energy. So, but in very near term, I'm going to say 65 on the Brent.
Yeah, it's interesting, isn't it? I mean, talking to fundamental analysts in the oil sector, they're also saying the fact that big oil is just not investing enough in new oil fields. So we're likely to get this demand supply imbalance again, which, as you say, ultimately, I guess, is going to lead to a spike higher. That all depends on what happens with the green lobby and the environmental push that I know we're all trying to make headway in. Let me ask you a question as well about one other area of the market which is getting some interest, and that is this weakening Japanese yen. Now, we know that the central bank in Japan is reluctant to raise interest rates. We've seen this almost generational move where we've seen Japan, the deflationary effect on all this. We're looking at equity markets which are so very close to those 1989 highs now. And I guess some of the move that we've seen up in the Japanese equity markets has been this weakening Japanese yen. We know that Japan is a big exporter and it likes to see a weaker yen, which is what it's got. But my question to you is, as a trader in the foreign exchange markets, should we keep with this long dollar yen trade?
To me, it's getting long in the tooth. there's there's again, there's two sides to the coin here. There's the very near term, and then there's the longer thing. So I would argue, for the time being, until we see a news event, I would not want to be basically short short this market, right? I would not be surprised if we start to see dollar yen go higher. Maybe it's 146 as the target. I'm not quite sure we go back to where we were in October of last year, which, by the way, just so you know, October of last year, when the dollar yen topped, is also when equities bottomed. So just kind of keep that in mind. So to me, that's kind of a similar trade. It's a risk on trade. So if this kind of reflects the equity market, and in many ways, it's the same, just literally inverse, if you will. And so I wouldn't be surprised if we start to see, once we start seeing global economic growth weaken, and or people actually want to believe it, then we'll start to see this start to go lower, and the yen basically strengthen again. But for the time being, I would not want to fight this. I would wait until we see, some sort of a move, a reversal, basically, if you want to be technical about it. But until then, this is kind of a sort of a near-term trend followers trade, as far as I'm concerned.
When there is a break lower, what do you think are going to be the points to watch out for on the way down, which could give us some support if we see a reversal of some of the recent upward move in dollar yen?
I like to circle the midway point of the rally so far. That's probably about 135 on this move, is probably what I would kind of see. So if I were to, let's again be visual about it, it's kind of this kind of a move as a good starting point, and then we'll just kind of measure it from there. But what will tend to happen is, and you can look at previous times when we have mean reversion or reversals on dollar yen, they happen quick. So you'll get a 1 or 2 day notice. That's pretty obvious. And then it starts to move from there. So we'll probably get a couple days warning before it starts moving. But you want to heed those warning signs pretty quickly.
Yeah. Look, Serge, we'll have to leave it there, but thanks indeed for joining us for this quick tour around some of the charts on the markets on this midweek trading session. Have a good festive week. That's Serge Berger. He's from the steadytrader.com, joining us for today's Charting the Markets.